Hello everyone and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be going over a question that I had someone ask recently in the YouTube comment section, but basically, what is the difference between the S&P 500 SPY ETF and then VOO ETF? So we have SPY, its ticker symbol is SPY, and it's a Spider S&P 500 ETF. And you can see the performance here is very similar to that of VOO. And VOO is the exact same thing. It's an S&P 500 ETF, except it's by Vanguard. Now you can see the performance is very, very similar over the last 5 years. So what is the difference between these stocks? What is the S&P 500 and what are the two differences between these two ETFs? I'll give you my opinion on which one I think is better out of the two, and then I'll overall just give you an opinion on my portfolio, where the stock market is doing, and then give you some update and some information about the stock market in general. But before we get into any of that, those of you that are interested, if you want to sign up using my link through M1 Finance, it's in the description of all of my videos. As I mentioned, we now have 16 successful referrals. Thank you 16 guys so much that have used that referral link. So go ahead and use that referral link in the description. You can get $10 and get started with your dividend portfolio like me. And as usual, if you stay all the way to the end of the video, I will give you guys an update on my portfolio with all of my positions that I have going on. So anyways, let's jump right into the video. So first thing, before I jump anything that's in these portfolios, in these ETFs, I want to point out a performance difference. So I want you to remember this number, 3.56. Now let's search VOO. But the performance for the year on VOO is 3.59. So just a tad bit better. Okay, well let's go back to S&P 500 SPY. The 2-year performance is 12.121. So remember that number, 12.121. But VOO's was 12.29. So a little bit higher. And then lastly, let's look at the 5-year performance. So if we look at S&P 500 SPY, it's 43.41, 4341. But VOO's is 4443. So about a 1% difference over a 5-year difference. So why is the stock VOO outperforming SPY just a little bit? What are the two differences between these? Well, the first thing I want to point out is you see the expense ratio here, 0.09%. Those of you that don't know, an expense ratio is basically like the fee that is charged for the management of this portfolio. The big investors who rotate the stocks in and out of here, you can see that this has 506 holdings. The people who manage those 506 holdings sell the ones that are extremely low, buy more of the ones that are extremely high. The people that do that, the management fees, is represented in this number at 0.09%. So that is what you're essentially paying to have this ETF ran for you. But with VOO, instead of 0.09%, its expense ratio is 0.03%. So I know it's minuscule. I know it's not a huge difference. So basically, you were going to be charged a third of what you would be charged for using the SPY. One of the reasons why I love Vanguard, those of you that watch my videos know that Vanguard is the one that I absolutely love the most in regards to ETF and investments. I think that they have some amazing ETFs, and VOO is no exception. It is absolutely on this list as well. But what are the two differences between these stocks? Let's look at the inside the portfolio. Let's look at inside the ETF and see the difference between these two. So I have Vanguard's website and then Spider ETF's website pulled up. You can see the gross expense ratio. If you get it down to a further, down to the thousandth or 10,000th, it's 0.0945%. And what you see with VOO, its expense ratio is just that 0.03%. But let's go ahead and look at the performance tab here for the S&P 500 Spider ETF, the SPY. So you can see some very similar numbers here. So the S&P 500, that those of you that don't know, it is the top 500 companies in the United States. There's no discrimination here. There's not one person saying, okay, this company is good, I like it, I want to put it in the S&P 500. It is strictly based on the number only, is their market cap the top 500 companies in the US and are they profitable? That's all you need to get in the S&P 500. So that's why a lot of the top holdings in the S&P are very, very large companies, the largest in the world like Microsoft, Apple, Google, Visa, stocks like that. So the performance for 1 month is 4.74 versus 4.76 for the real S&P. 18.14, 18.19, negative 5.02, negative 4.97, 12.65, 12.84. You see the pattern here. You see how they're very, very close in performance over the long run. Even if we go here all the way to 1993, you can see it's about a 0.13% difference, so almost exactly the same. So basically, with the S&P 500 SPY and then VOO Vanguards, it's going to be about the exact same. So if we go down here, if we go to the top holdings, let's go ahead and look at the percentage weight. You can see here, this is the fund's top holdings for the net asset value of the SPY stock versus the actual S&P 500. 5.95, 5.95, 5.82, 5.82, 455, 455, and it just keeps going on. So let's go ahead and look at VOO. Let's look at Vanguard and see if they have similar performance and see if they have some of the same things. You can see here, this is diversified between different compositions of sectors. So you can see here 11%, 11%, 10.6, 10.5, just a teeny bit off, 7.1, 7.1, 2.9, 2.9. And you can see a lot of the top holdings are identical to that of S&P 500 SPY stock. So it's going to be a lot of the exact same holdings. And if we go down here to sector allocation on the SPY stock, it has a lot of the exact same to that of VOO. It matches the S&P 500, the largest one being information technology at 27.32%. And then you can see it matching up on a list view right here. So those of you that are curious, I do have the annual report for the S&P, for the SPY stock. If we go here, if we scroll down, yes, right here, this is sorted alphabetically. You can see down to the number of shares, the value of those shares, and it's pretty interesting. Those of you might not be interested watching this video, but I'm definitely a numbers guy, so for me, I think it's really interesting to see this. And those of you that are wondering, the largest company in the world right now, which is Apple, where is it at? So Apple right here, I'm going to highlight it, those of you that are trying to find it. They have 47.1 million shares of Apple Incorporated, and this is absolutely huge. And if we go and find Microsoft, let's go ahead and scroll through the list here and find Microsoft right here. Microsoft, they have 84.7 million shares of Microsoft, worth about 11.8 billion. That is absolutely incredible. And another thing about these two stocks I forgot to point out, if you search SPY here, the market cap of SPY, it is the largest ETF on earth. It has 270 billion assets under management, and then VOO is a little bit smaller at 139 billion assets under management. So about half the size of that of SPY stock. But yeah, if you're interested in pausing the video, I'm just going to slowly scroll through all these positions. So if you want to scroll through any of these positions and pause the video, you can look at any one of these. Okay, but now that you've seen the two differences between these stocks, my question is, what is the difference and should you invest in which one? Now, the good part is, if you're investing in the S&P, what the S&P 500 is, like I mentioned, being the top 500 companies in the United States, it doesn't really matter which one you pick. You're not going to make a mistake. Now, when you pull up the research tab here through M1 Finance, immediately it pulls up as the three indexes, and the one that it uses is the SPY. Now, the reason it pulls up the SPY is because if you hit the research tab and then you hit click funds here, and you sort by assets under management, it is the largest one on earth, so it's going to use the default one for SPY since they are the largest and they're the most popular. But in my opinion, if you're going to pick one between the SPY and you're going to pick one between SPY and VOO, I think that my opinion is that you should go with VOO over SPY. Now, the good news is there's a very minuscule difference. There's hardly any difference between the two of them, but the only main thing is the expense ratio. They're managed almost identical. They're almost exactly the same. It's hard to find any difference. They're supposed to be that way, but the management fees, the expense ratios, it's just a little bit smaller for VOO. So in my opinion, I think you will outperform with VOO over SPY in the long run. Not by a huge difference, but those of you that are interested, I now went over that and you know to invest in VOO over SPY. But let's go ahead and get into some information about the stock market, some information about what's going on with the economy. If we search here and we type in AMC Theaters, now AMC has been a stock that we've covered a couple times on the channel. I think that you should absolutely stay away from the stock. The dividend yield has not been updated yet. That is to zero. They cut that dividend down to zero. Now, those of you that don't know, AMC have recently came out and said that they're probably going to end up filing bankruptcy during this recession. They ended up getting talks publicly with a bankruptcy law firm, and they might be filing a Chapter 11. So those of you that don't know, do not invest in AMC, because I think if you're buying the stock, the only thing that you could hope for really is praying to God that they get bought out. Now, the good news is there's been some rumors that AMC will potentially get bought out by Amazon. This is all speculation. There's no proof behind this, but there's been a lot of talks about AMC being bought out by Amazon, and I think with a $500 million market cap, Amazon could do this very easily. So if we type in Amazon balance sheet here and we go to Amazon's balance sheet on NASDAQ.com, that's the one that I like to use, and let's go ahead and look about how many cash and cash equivalents they have on their balance sheet last reported. So as of right now, between short-term and cash equivalents, they have over $50 billion worth of cash and cash equivalents, 36 just in cash ready to go. So you see here their market cap for AMC is $500 million. So they could buy out all of AMC theaters, buy out the company entirely, even if they were to buy it at a premium, pay off all of its debt, and then make it a profitable company overnight. They could do that without even putting a dent in their balance sheet. Like I said, they have about 50 billion roughly. But if you were to pay a premium for the stock, let's say they had to pay 1 billion to pay off all the debt and then buy the company outright, they would still only have to put out 2% of their cash that they have available. They would still have 98% of their money available. So to say that AMC can get bought out by Amazon is definitely a realistic scenario. Those of you that don't know, Amazon does acquire a lot of other smaller companies. They have acquired, just to name some big names, things like Whole Foods, Zappos, Twitch.com. There's been a lot of other companies that Amazon has bought out, and they continue to make acquisitions of smaller company to rely on that growth. But as far as a profitability standpoint, I think it would be really interesting with AMC if Amazon was to buy them out. Because if they were to buy them out, I think we would probably see some kind of mesh up between your traditional movie theater and your basic streaming platform. So an idea that I had personally was maybe with Amazon Prime Video, when they release a new hit movie or they release a popular TV show, what they could do is have a short release to where they could release these at AMC theaters exclusively. So if you had, for example, so like one show that I like to watch is Ozark. So Ozark is actually a show on Netflix. It's one of my favorite shows, and also like shows like Westworld, stuff like that. But if they were to have a release of a popular TV show that everybody got excited about, and they were to release it exclusively on AMC, and then maybe offer a discount or something like that, if you were an Amazon Prime Video member, you could go to AMC theaters. And those of you that don't know, majority of the margins for AMC strictly come from the things outside of movie tickets. It comes from the $8 Coca-Cola that you're going to buy, the $10 popcorn with butter that you're going to buy, the arcade that's next to the movie theater. A lot of their margins and a lot of their profit does not come from the actual movie ticket. So I think this would be a great way for Amazon to try to drive traffic to AMC, and I think they could buy them out for an extremely low price, 84.25% lower than they could have tried to buy it 5 years ago. And they could do this while still keeping 98% of their cash. And you know that Amazon and potentially AMC, if they were to buy them out, could both be extremely profitable. But anyways, back to the news about AMC. The reason why I wanted to cover this is because I have covered it on the channel. AMC Theaters will open 450 of its U.S. locations on July 15th and the remaining 150 theaters on July 24th. I think in regards to talking about profitability and bankruptcy with this company, the fact that they've had to push out their reopening schedule further back has really hurt the company. And now, those of you that don't know, cases have spiked up for those that are getting affected by the coronavirus daily. So I think that the schedule might even get pushed back further, or they might even have to temporarily reclose some of those opening theaters. So if that were to happen, once again, this has just been a nightmare for AMC. The growing debt pile, the shrinking revenue, the closing of the theaters because of the coronavirus, the potential pushback for the schedule, and even pushing back even further. I think it's just the absolute worst case scenario for AMC, and I don't see this really getting any worse for them. I think that in the long run, if you're wanting to invest in the stock, don't rely on a buyout. Don't invest in it. You're not getting paid any dividends. The stock price more than likely will go down in the long run unless they get bought out. So don't buy this stock and steer clear of it. And then speaking of stocks that are going through a lot of trouble right now, let's talk about Carnival Cruise Lines. Carnival extends cruise cancellations through September 30th. So in regards to AMC, when we were talking about them extending cancellations further out than they were initially planning, let's talk about Carnival, who's doing the exact same thing. Now, let's talk about pre-recession, pre-coronavirus. Before this recession, Carnival Cruise Lines was a company that I really liked. I didn't like that they were consumer discretionary, but they had a growing dividend, they had a solid business model, and they had growing revenues every single year. They were a very healthy company considering compared to the other cruise companies, and I think that in the long run, this company will not go bankrupt. I think they'll do just fine, and I think that this is a solid company. after the coronavirus passes. That said, they have been hit with a wave of issues, no pun intended, a wave of issues from the coronavirus, and now they've had to push their cancellations all the way through the end of September. Those of you that don't know, back when the coronavirus was first hitting in February and March, they were extending cancellations through like May and June, and now they're extending them to where they won't even get boats back out in the water until like October. Now, who knows if this cancellation schedule will hold up? It might get pushed back even further. But those of you that don't know, if you're interested in buying Carnival Cruise Lines, it is at an extremely low valuation. But I think buying a CCL, a Carnival Cruise Lines, is very similar to buying, say, something like an airline stock. So like Southwest Airlines, I think that LUV Southwest Airlines is going to be very safe in the long term. That said, they're hitting an immense amount of issues that they never have faced before. So me personally, I don't like to buy companies that don't pay dividends. Both of those companies have cut their dividends just like AMC, and I think in the long run they're not going to go bankrupt unlike AMC, but I think they have a lot of issues going ahead of them, and reaching profitability will probably not happen at least until 2021. So I think if you want to buy this stock as a spec play, just like LUV, like Southwest Airlines, if you want to buy this stock as a speculative play, I think you have a massive potential for share price gains. I think that eventually, fast forward 2, 3, 4 years from now, when they get back to that profitability and people aren't as scared about going outside and getting sick anymore, I think that in the long run, Carnival Cruise Lines will do extremely well. I think that they will eventually get back to paying dividends several years from now. I think that that debt load will get a lot smaller, and I think that they'll get those growing revenues back as they had a lot of trends going towards Carnival Cruise Lines being in its favor. But overall, guys, we'll see if that holds up. I know a lot of businesses just in general, not only with the hospitality sector, but just in general, people are either closing their businesses back down like Apple has, or they're extending deadlines to open things back up. So we'll see what goes on with our economy and overall with the stock market. But thank you guys so much for watching all the way to the end. If you made it all the way to the end of the video, like I said, as I remind you guys in all my videos, make sure to use this link down in the description. You can get $10 just for signing up. I have 16 successful referrals, so if you haven't used that referral link yet, go ahead and use that referral link and you get $10 just for signing up with your dividend portfolio. And if you are interested in investing in the same stocks that I am or some of the similar stocks, you can share this pie right here. It's in the description right here. And if you put that in your tab, it will be posted into your web browser and you can see every single stock personally on your own time, the stocks that I own. But thank you guys so much for watching all the way to the end. I'm going to give you guys a quick update on my portfolio. While we have it pulled up here, yeah, basically after today's big drop, we now have a 3.5% dividend yield in total through the portfolio through our 31 holdings. And then if we see here, I'll scroll through all of my positions. If you want to pause the video and see how I'm performing on any of my positions, go ahead and do that now. And if we sort by best performers, Discover Financial Services was our best performer. It has been our best performer for quite a while. Those of you that don't know, at one point we were actually up 110% on Discover, but we are still up 73%. A lot of our biggest winners are still doing very nice, and our biggest losers in the portfolio, it's great to see, and I'm super excited being a dividend investor that we now have a couple of stocks that are actually in the red. Not just talking about, oh, we're up 10% on the stock, we're up 20%, we're up 50% on the stock. I finally get to average down on some positions, especially with WP Carry. It has went down pretty much since the moment I bought it about a week and a half ago. But we now have 1, 2, 3, 4, 5, 6 different companies in the red, including some dividend aristocrats. So overall, we're doing very good in the portfolio. A overall return through the whole portfolio. I like to look at the time-weighted return. That's what I'm going to start showing you guys. We were up 11.25%. That is the time-weighted return of $261 worth of market gain, and that is the time-weighted return of 16.26%. And the market gains are $280.42, and earned dividends is $19.56. Some of the recent dividends that I've received, if you want to see right here, I did just receive some dividends from Dominion Energy, Waste Management, Home Depot, Whirlpool, Realty Income. Some of the names off right there. But overall, guys, the portfolio is doing very well. Thank you guys so much that have watched my videos and are subscribing to the channel. The number of people subscribed to the channel has picked up quite a bit, and we are getting closer to monetization. So if you subscribed or have not subscribed yet, go ahead and hit the subscribe button down there. Thank you guys so much for watching. Leave a comment down below what you thought about this video. What do you think is better, SPY or VOO? Was there something that I missed, or do you think that I covered both these ETFs very well? Thank you guys so much for watching. Make sure to use the links down in the description, and I'll see you next time.